Welcome to Honest Money. On today's episode, Warren Ingram answers your questions around investing offshore, more on RSA retail bonds, investing on credit, and touches on the importance and difference between life cover, income policies, funeral cover, and disability cover. Listen for more.
My question is twofold. Firstly, what would you do with a large lump sum at present if you're actually wanting the money to go offshore? Would you wait for the exchange rate to get to below 15? And secondly, what do you think of the RSA retail bonds at 9.75% guaranteed for 5 years? Thank you.
Thanks, lump sum investor. I think that's a brilliant question at the moment. Lots of people are looking at overseas markets, especially now that they've taken quite a big knock, and asking themselves if this is a good time to be a buyer of international shares. And I think the answer is yes. I wouldn't necessarily take all my money and invest all of it in one big lump sum in international markets, but certainly I think it's a good time to be a buyer of overseas investments. The question then, the complexity is, if you're sitting with a lump sum in rands, your first decision is, when do you convert those rands into dollars? I have been saying for quite some time, and I haven't changed my view, that I think the rand dollar exchange rate that you're looking for is about 15 rand 50 to the dollar. So when the rand is trading at 16.20 or 17 rand or something like that, you probably want to wait a while until the rand gets a bit stronger and gets, around about that 15 rand 50 level. I don't think you need to be very precise. If you buy your rands at 15.70 or at 15.30, that percentage difference is quite small. But I think you do need to give yourself a target, and I think 15.50 is a very good target. So certainly for me, I think building up the offshore allocation to make sure it's a good part of your balanced portfolio makes sense. I wouldn't send my rands out at any exchange rate, and I definitely wouldn't do it in a panic. I think there's still some strength in the rand to come because there's a demand for South African commodities, and once the world kind of stabilizes and gets a little bit less fearful, the demand for commodities will continue to increase, and that means that we'll get more people bringing in dollars into South Africa to buy our commodities, which is strong for the rand. So long story, but the short answer is 15.50 is your level if I'm sending a big lump sum out. Your second part of your question was what do I think of RSA retail bonds? Having looked at their website, just to understand the interest rates, I think the rates are very good. I think for someone who doesn't pay a lot of tax, so if you're a bit older and you're able to earn a fair amount of interest, so because I think that's the key here. You obviously, all of the growth that you're getting on your investment is all taxable interest. You need to make sure that if you're going to get a substantial amount of money locked into an RSA retail bond, that you're getting a chunk of that is tax-free. And the only way you can do that is through the interest abatements that we get as taxpayers. So yes, I like RSA retail bonds. They're guaranteed by government. So it's one of the very few reliably guaranteed investments in South Africa. Just be careful that you don't end up losing half of your interest that you're earning to tax. So you must be a low interest earner before this will be sensible for you. What I would also say is that we know the Reserve Bank's very worried about inflation, and so there's a good chance that interest rates are going to go up in the next few months and at possibly a year or two. So that means I wouldn't lock my RSA retail bond into the 3 or 5 year option. I would rather lock it into the 2-year option, because there's a good chance that if you start your RSA retail bond at a 2-year fixed rate in June or July 2022, that by the end of 2022 or the beginning of 2023, interest rates are higher. And if you want to then take advantage of that higher interest rate, you're allowed, but you can only do it after 12 months. And that's an important thing. So you would then, after your investment's been going for 12 months, you'd be able to restart the term for a new 2-year period, and then you'd be able to take advantage of that higher interest rate. So just be careful that you don't, lock yourself into an interest rate now for a period of 5 years and actually regret it, because in a year's time you could have got a rate that was, half to 1% higher than what you're earning now. But other than that, I have no concerns. I know every now and then people complain about the admin, that they say the admin isn't brilliant, but frankly, no product provider's admin is brilliant. So that's not a big issue for me. And the fact that it's guaranteed by government, I think is a good call. So no problems on my side.
Morning, Warren. This is Clarence here. My question is, I have access to some money on credit at 17% interest rate after 62 days. So for the first 62 days, you don't pay any interest. I do not have any debt. I just retired. So I'd like to use about, say, 20 to 30,000 to invest in shares on the Easy Equities platform. What are your ideas and suggestions? Thank you so much.
Hi, Clarence. I'm so glad you're calling in with a question like that, because I think there are lots of red signs, red robots for me here, red flags, danger signs. All my kind of air raid warnings are going off like crazy. So I'm really glad that you're asking the question before you take the leap. So when you are retiring, I think it's really key that you retire with no debt, and then you do everything you possibly can to stay debt-free for the rest of your life. I think when you are retired, you don't have a lot of time on your side if things go wrong with your investment portfolios or other things go wrong in life. And if you then got debt and you can't earn an income to cover that debt, life becomes really hard very quickly. The alternative is that you might be able to get work again one day, but you're doing lots of stuff under pressure at a stage of life when you should be kind of taking your foot off the gas a bit and enjoying life. So my first main comment there is, being debt-free at retirement is an absolute key, and you should do everything you can to protect that status. It's a real almost a privilege nowadays to be debt-free at retirement. Even if you don't have a huge amount of investment income to cover your monthly costs, being debt-free is really key. So that's my first comment. Secondly, to borrow money to invest, I'm not a big fan of just in general. I think understanding that if you're going to borrow money to invest, you need to be fairly sure that the return you're going to get on the investment is going to more than cover the costs of the borrowing, and it needs to do that for a longish period of time. To understand what I'm saying is, if you borrow money now to invest in the stock exchange, and yes, I know the stock exchange is quite cheap. We've had the whole big scare in the Ukraine, and the JSE is trading at below 70,000, and by all accounts, in any measure, I think the JSE is offering good value. So there's a good reason to be an investor in the JSE when it's cheap. I like that idea, but it could stay cheap for another year or 2 or 3. We just don't know when the prices recover. We hope they recover in 3 or 6 months' time, but we don't know that. It's not a guarantee. However, the money that you're going to borrow, that interest rate that you're going to pay, that's absolutely guaranteed. And in your case, you're saying you're going to be paying somewhere around 17% interest on that money. Now, that's a guaranteed rate. 17%, you're going to owe someone that money. If you can't afford it because your investments are not going up, you're going to need to find that money from somewhere, or you're going to end up in trouble. And unfortunately, there are no investments. There are no high quality, good investments that are not a scam that can guarantee you an interest rate of, let's say, 20% a year for the next 5 years. There are lots of scams that will promise you that, but there's nothing that can guarantee you that return that's a proper high quality investment. So I think that the interest rate is far too high for you, even though you were saying the first 62 days are interest free. Just understand that in 62 days from now, the shares that you've bought might be worth less. And then you've really got issues if you need to start paying back that money. So please stay debt-free. Please don't borrow money. I think it's really not a good idea. If you were borrowing the money at an interest rate of 1 or 2% or something like that, then I think it makes sense. But those rates are hard to find nowadays, and certainly that they're rare on their own. So when you're borrowing anything at an interest rate that's higher than inflation, you need to be really careful of borrowing to invest. But the only time it makes sense for people is if they're borrowing against an income producing asset like a residential or a listed property or something like that. But even then, you've got to use debt very carefully. So Clarence, long story short, stay out of debt, please. And rather, if you want to buy into the JSE, do it with 50 Rand a month if you can, if you don't have any other money spare, but don't borrow money to invest.
Hello, hi Warren and the Money Podcast team. My name is Ntlezwane. I'm 24 years old and I just started my first job. So I see a lot of talk about retirement and investing. And there's few talks around life cover and funeral cover. I've gone around budgeting, talks about budgeting, I've seen those. So, yes, should I take a life cover or funeral cover or both? I've seen life covers with disability covers. Yeah, some advice around that life cover and funeral plan topic. Thank you.
Hi, Ntlezwane. That's a really relevant topic, starting your working career with the prospect of a long life ahead of you. It's important to also worry about the risks that you'll be facing. And I think looking at funeral cover, life cover, and disability cover are really important. But before we kick off on that, I just wanted to say congratulations. Starting your first job is a big step in the world, and in a time when employment is a really difficult thing to get, it's a real compliment to you that you are in the working world, and I wish you all the best in the months and years ahead. I hope you have a fantastic career, and I hope you get to financial freedom as fast as you possibly can. So with all the nice stuff out the way, let's talk about funeral cover. I think the first thing to do is to check with your employer whether you don't already have funeral cover as part of your employment agreement. You might find that some of the deductions that they take off your salary, which will be things like tax, maybe medical aid and the like, you might also find that they're deducting money for a funeral policy. A lot of the bigger employers will do that. And if that's the case, then you'll find that cover is quite cheap already, and certainly will be sufficient to cover you and potentially any financial dependents that you might have. So if that's the case, then you don't need to worry about getting any other funeral cover as well. Having said that, if you don't have funeral cover from your employer, then yes, I think getting funeral cover is an important thing to do. What I would suggest is make sure you shop around. Make sure that you get at least 3 quotes from anybody who is going to provide funeral cover insurance, and then be very clear with everybody that's providing you those quotes that you are going to shop around and that you are going to show the quotes to other people as well. So if you're getting an offer from one company, funeral cover A, then say to funeral cover A, look, I'm going to show your cover and the quote that you've given me to funeral company B, and I'm going to get them to compare what they're offering me to what you're offering me, and I'll do the same with you. But by the end of that, once you've done that with 3 separate companies, you'll have a really good idea of whether you're getting the right cover, whether you're paying the right price, etc. But please shop around, because I know funeral cover can seem like a small amount on a monthly basis, but it's actually quite an expensive form of cover. And I must say, I think that there are lots of companies out there that are not offering great cover, so make sure you shop around. For disability cover, I think that it's an absolutely key thing for young people. I think when you start work, you've got a long life ahead of you. Potentially you could work to age 65 or longer if you wanted to. It's important to make sure that you ensure your ability to earn an income for the rest of your working career. And that's what disability insurance does. So, we live in a risky country. Just driving to work every day can be risky. So make sure that you do have disability cover. Once again, ask your employers if you've got disability cover as part of your overall package there, because if you do, the cover that you get from a group is group employment is much cheaper than you can get on your own, and usually will be sufficient for your purposes. But if you don't get that cover from your employer, then make sure that you do shop around again. I think at least 3 quotes again. and tell everybody that you are going to show their quotes and get them to compare the benefits of each of their products with the other products that you are being offered. I prefer getting the disability insurance called income protection, because it will give you a monthly kind of a pension for the rest of your working career, which I think is much safer than getting a disability, a capital disability amount, which, in other words, you get a lump sum if you are disabled rather than a monthly income. And the reason why I prefer income protection is simply because your disability might be the form of mental damage. If you have a car accident, for example, and you've got a brain injury, it might compromise your ability to make sensible decisions for the rest of your life. Then at least making sure that you've got a guaranteed monthly pension from an insurance company makes more sense to me and is a safer way than getting a big lump sum where you might end up making bad decisions simply because your mental capacities are limited, or you have to rely on somebody else and they might take advantage of you. On the last comment around life cover, I think there's not much need for life cover when you are starting work, unless you've got financial dependence or you've got debt. So if you are, if there's no one that's relying on you financially when you start work and you've got no debt, then I don't think there's much need for life cover. But if you've got debt, then definitely make sure you've got enough life assurance to cover that debt and maybe a little bit more. And obviously, if you've got financial dependence, whether it's children or parents or siblings, then you might need to get life insurance as well, so that they are not going to be financially compromised if you die. The nice thing about getting life assurance when you're young is that it's very cheap, and certainly not that painful to pay as a cost on a monthly basis. Obviously, none of us want to pay insurance, but it's not a bad one if you've got financial dependence. Once again, I know it's not going to surprise you. You need to shop around, make sure that you're getting the right cover, and always compare apples with apples. Make sure that you compare the three quotes with three providers, and make sure you understand what you're getting into, because these contracts can be very complicated, full of jargon, and not necessarily in your best interest. So always shop around and be transparent about the fact that you are shopping around. I wish you all the best in the months and years ahead. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.